Revenue down, profit squeezed, but cash is piling up. Is Venture Corporation quietly setting up for a rebound while others panic? In this video, we break down the Q1 2025 numbers and tell you why Venture might just be a hidden opportunity in today's volatile tech landscape. Hey investors, welcome to Durian Finance, where we turn complex financial updates into simple, actionable insights. Today, we're diving deep into Venture Corporation's Q1 2025 earnings, a company that's not flashy but quietly consistent. We'll decode the numbers, the strategy behind the scenes, and where things might go next. Stick around till the end where we'll share our verdict and whether it's time to buy, hold, or wait. This video is for educational and informational purposes only and does not constitute financial advice. Always do your own research or consult a licensed financial advisor before making any investment decisions. Let's break down Venture Corporation's key financials for the first quarter of 2025 and what they actually mean for investors like us. First up, revenue came in at 616.6 million Singapore dollars, down 7.5% year on year. But here's the nuance. The drop was mainly due to lower demand in the lifestyle consumer tech segment, where Venture actually improved product reliability, leading to fewer replacements. Not lost sales, just better engineering. Despite this, net profit held strong at 55.9 million, showing that Venture still managed to protect the bottom line. And they did it efficiently. Net margin improved to 9.1%, a clear sign of tight cost control and high-value solutions. Now looking at earnings, EPS came in at 19.3 cents, a small dip, but still very healthy and enough to fully cover dividends. In terms of valuation, the PE ratio is about 13.2 times, which suggests the stock is fairly priced, maybe even a little undervalued given its fundamentals. And the price-to-book ratio sits around 1.13 times, very reasonable, especially with net asset value per share rising to an all-time high of 10 Singapore dollars and 11 cents. If you're income focused, here's the good part. Dividend yield ranges between 6.6 and 6.9%, one of the highest yields in SGX's tech sector. The payout ratio is around 89%, which is high, but still manageable. And with a dividend coverage of 96%, the earnings comfortably support the current payout. So in short, this is a company that's managing margin, maintaining cash flow, and rewarding shareholders, even in a down revenue quarter. Venture's Q1 2025 generated 55.4 million Singapore dollars in net cash from operations, down from 132.9 million Singapore dollars in Q1 2024. That shows they're still cash generative, though operating cash flow has moderated compared to last year. This strength supports ongoing dividends, share buybacks, and digital R&D investment. Venture's Q1 2025 results show a dip in revenue, but it's not the whole story. Their net margin improved, earnings are still strong enough to cover dividends, and the book value per share hit a record high at 10 Singapore dollars and 11 cents. With a PE around 13 and dividend yield nearing 7%, this is looking like a quiet winner for steady income investors. While revenue dipped, the key highlight is profit margin resilience. Venture managed to expand its margin to 9.1%, even in a softer top-line environment. That's not easy and speaks to its operational efficiency. Do you think profit margins matter more than revenue growth in today's uncertain environment? Drop your take in the comments. Let's talk cash, because with Venture, cash remains king. In Q1 2025, Venture generated 55.4 million Singapore dollars in net cash from operations. That's a robust figure, especially considering it's an improvement of 20.8 million Singapore dollars from the previous quarter. This uptick highlights the company's continued strength in converting its operations into cash flow, despite a dip in revenue. But there's more to the story. Venture's proactive management of working capital, including a reduction in inventories, has significantly improved its liquidity. This means the company isn't just generating cash. It's efficiently managing its resources to bolster its balance sheet. And if that wasn't impressive enough, Venture has also committed to returning value to shareholders. So far this year, they've executed 17.4 million Singapore dollars in share buybacks. These buybacks not only signal management's confidence in the underlying business, but also help enhance shareholder value by reducing the total number of shares outstanding. In short, despite facing headwinds on the revenue side, Venture is demonstrating that strong cash flow and disciplined capital management can serve as a powerful foundation for long-term growth and stability. Venture's management signaled a cloudy 12-month horizon, citing tariff uncertainties and global macro risks. This echoes broader investor caution. U.S. tariffs on Chinese goods have rattled markets, with the IMF warning they could reduce global growth to just 2.8% in 2025. Meanwhile, market watchers from S&P and Reuters note tariffs are already triggering volatile earnings seasons. But Venture isn't waiting for perfect conditions. Their multi-pronged strategy includes leveraging global site synergies, improving scalability, and reducing costs across multiple manufacturing locations, expanding market share in 3 to 4 high-growth domains, namely life sciences, semiconductor equipment, data center/networking, and industrial automation, areas with less exposure to consumer spending dips, doubling down on innovation-led product development, ensuring new CAPEX by key clients, while adding technical IP and deepening client integration. This isn't a game of opportunism. As private equity leaders suggest, today's environment demands operational resilience and strategic foresight. Venture is building long-term client stickiness, not chasing short-lived growth. That positions them not just to survive, but to emerge stronger when global conditions stabilize. Venture isn't just generating cash. They're building a fortress. Here's a breakdown of their financial stronghold. Cash and equivalents, 1.32 billion Singapore dollars as of the most recent quarter. Net cash position. Even after setting aside debt, the net cash stand remains well over 1.3 billion Singapore dollars, providing flexibility for investment or shareholder returns. Shareholder equity/NAV per share. With equity of approximately 2.89 billion Singapore dollars, NAV per share hit a record 10 Singapore dollars and 11 cents, consistent with Q1 trends. GrowBeansprout.com. Total debt, almost non-existent. Long-term debt to equity is effectively 0%, signaling zero financial leverage. Debt to equity ratio, around 0%, though minor offshore borrowings bring this down to a negligible 1%. Here's why that matters. With such a strong balance sheet, Venture has plenty of breathing room to weather economic slowdowns, invest in R&D, expand globally, and maintain dividends, all while avoiding the risks associated with debt-funded growth. That kind of financial discipline doesn't just survive downturns. It positions a company to accelerate when conditions improve. So here's the summary. Margins are solid. Cash flow is rising. Buybacks are active. Revenue down, but strategically. External risks, but a balance sheet says bring it on. Venture isn't a moonshot tech stock. It's a cash-yielding machine that's still innovating, still reinvesting, and now trading near NAV. Would you buy Venture Corporation at this level for dividends and stability? Or are you waiting for more growth? If you found value in this breakdown, smash the like button. It really helps the channel grow. Subscribe for more clear, no-hype analysis on SGX stocks. And if you're watching this far, thank you. Which SGX stock should we cover next? Drop your pick in the comments.